Hello everyone, I'm Ankur Chaudhary from Hitbullseye.com, and in this video lecture I'll be talking to you about the banking sector in India. First of all, let us see the story of evolution of banking sector in India. In 1960, the State Bank of India was given the control of 8 state associated banks under the State Bank of India Act of 1959. So, banks like State Bank of Hyderabad, State Bank of Travancore, etc. came under the direct control of State Bank of India in 1960. Later on, another major event was the nationalization of banks of 1969. So in 1969, 14 banks which were earlier privately owned were bought by the government of India. This is because that these banks were earlier owned by large businessmen, and now the government took control of them to further their social welfare agenda. Later on in 1980, 6 more private banks were nationalized or bought by the government of India. In the later phases, we've seen greater amount of liberalization and privatization of banks in India. In 1993, 10 new bank licenses were given and new banks came into being like ICICI, HDFC, IDBI, etc. Later on in 2001, Kotak Bank and Yes Bank were given universal banking licenses to perform all the functions that are performed by banks. And more recently, after a gap of 13 years, 2 more companies got banking licenses, that is IDFC and Bandhan Finance. Further, we've also seen the coming in of foreign sector banks in the country. Now recently we have increased the FDI limits or foreign direct investment limits up to 74% in the banking industry with some amount of restrictions from the Government of India and the Reserve Bank of India as well. Another new development, that is in the past couple of years only, we have seen the oncoming of differentiated banking licenses in the form of small banks and payment banks. Now, it was seen that the conditions that were applied for banks, for licenses of universal banks, they were very harsh. So, not a large number of companies were able to set up shop in the banking industry in the country. Hence, the need was felt that a different type of bank should be introduced with lesser qualifications, and as such, small banks and payment banks came into being. Now let us understand what these banks are all about. First, let us talk about small banks. So small banks can accept current account and saving account, CASA, FD, that is fixed deposits, and recurring deposit accounts, right? They can give out depositors money as loans to other customers, but the important thing is that they have a very small area of operation, right? So every small bank will be operating in a limited area, but within that area they can perform all the functions of a huge bank like SBI, HDFC, ICICI, etc. The small banks will be targeting customers which are MSME, micro, small, medium enterprise businessmen, unorganized workers, small and marginal farmers, and their focus will remain on getting more and more deposits as well as disbursing greater loans. The basic idea being that it functions as a universal bank or a normal bank, but within a limited area. Next, we talk about payment banks. So they can only accept current account and saving account deposits and not FDs and RDs. Payment banks cannot give loans, but they can invest depositors' money in government approved securities only, right? Their target customers are poor migrants, unorganized workers wanting to send remittances home. So as far as payment banks are concerned, they'll be utilizing the mobile banking platforms, internet banking, etc. to ensure that people who are living outside of their homes are able to send back money to their places using the electronic or mobile platform. So their focus will remain on payment remittances only, including cross-border remittances, right? So payment banks can operate throughout the country but have a limited operations, and their focus remains only on remittances or sending of money from one place to the other. So now we look at certain important laws which govern the banking industry in the country. Now you do not have to go into greater details of these laws, and you have to only cover the broad or major areas that these laws are talking about. First one is Banking Regulations Act of 1949. So as the name suggests, it regulates all banking companies or firms in the country. It is applicable to cooperative banks as well, but only since 1965. It gives RBI the power to give licenses to banks, have regulations over the shareholdings and voting rights of shareholders of these banks. So this is a very important act, as it gives RBI the power to give more licenses to the new banks. Next is the RBI Act of 1934. So RBI, again, this is a very important act, as RBI was established under this particular act. It contains the definition of scheduled banks in Schedule 2 of this act. The section 18 deals with emergency loans to banks, and the other important sections are section 21, 22 and 24. Section 24 is very important for objective type of questions. It states the maximum denomination a note in India can have is rupees 10,000. Next one is Negotiable Instruments Act of 1881. So it defines the important negotiable instruments like promissory notes, bills of exchange and bank checks, and also gives various types of checks. So different kind of checks can be local checks, outstation checks or at par checks. Further, we have bearer checks, crossed checks, open checks, etc. So these are certain checks that you have to know the meanings of and understand the meanings of for your paper's point of view. So in the subsequent slide, we'll talk about the structure of the banking sector in the country. So these are the different types of banks that we have in India. First, let us talk about the central bank. The Central Bank of India is, of course, the Reserve Bank of India. It was established on April the 1st, 1935 under RBI Act 1934. So these facts are again important for any competitive examination with objective type questions. So these are the various main functions that the Reserve Bank is performing. First of all, it is the monetary authority of the country. That means it controls the money supply in the country through its monetary policy. As far as monetary policy is concerned, I have covered this in a previous lecture. Secondly, it is the regulator and supervisor of the financial system of the country. So it makes rules, prudential norms, etc. for the entire financial sector as well as the banking sector of India. RBI, as a manager of foreign currency, is the custodian of forex reserve or foreign exchange reserve of the country. So India maintains a forex reserve which contains foreign currency like dollars, yen, euro, pounds, etc. Further, gold, SDR, etc. are also included in this particular forex reserve. So RBI is the custodian of India's forex reserve. Further, as a manager of foreign exchange, RBI is also empowered to manage foreign exchange under this law, that is Foreign Exchange Management Act of 1999. So this act gives certain limits of the amount of foreign exchange or dollars that you can take out of India. So RBI is also the sole authority as far as this act is concerned. Next is RBI is the issuer of currency. So RBI prints all the currency notes of the country. The coins, of course, are minted by not the Reserve Bank of India but the Ministry of Finance. Also, another important thing is that the newly or recently introduced rupee 1 note is printed by Ministry of Finance and not RBI. So coins and the rupee 1 note is printed by the Ministry of Finance. The rest all currency notes are printed by the Reserve Bank of India. Furthermore, RBI also performs certain developmental roles. and it introduces various schemes like local area scheme of 1999, etc. Next, RBI is the lender of last resort for other banks. So when other banks need money and they have exhausted all of the sources of getting credit, the RBI is the place that they go to for asking more money. Lastly, RBI also acts as the banker to the government. So RBI maintains the Consolidated Fund of India, right? So this is the biggest fund wherein all income tax or central taxes are deposited, or other earnings of the government of India is deposited. This particular account is taken care of by the Reserve Bank of India. Similarly, to the Consolidated Fund of India, we have the Consolidated Fund of various states. So this Consolidated Fund is also taken care of by the Reserve Bank of India. Next, we take a look at commercial banks. So these are profit-seeking institutions which accept deposits from general public and advance money to individuals in the form of loan, credit, etc. Their main source of income is the differential between the rates that they charge to borrowers and the pay to depositors, or in other words, the interest spread. So as we all know, their operations are regulated by the Reserve Bank of India. So there are different types of commercial banks in India. So first is the scheduled banks and the non-scheduled banks. Scheduled banks are those banks who are registered with the Reserve Bank of India, and their names appear in the second schedule of the RBI Act of 1934, right? Conversely, non-scheduled banks are not registered with RBI as such. However, as of now, there are no non-scheduled banks in the country. Next, within scheduled banks, we have different categories of banks like foreign-owned banks, private sector banks, and public sector banks. Next, what we have is RRBs, that is regional rural banks. These are owned by the government and mainly operate at the local levels or for the development of rural areas in the country. So next category of banks is cooperative banks. These are different from commercial banks that we discussed earlier. So these are banks which are registered under Cooperative Societies Law of the state government in which it is found. So every state has a different law with respect to cooperative societies. So this type of bank, that is cooperative bank, is registered with the state government as a cooperative society. It serves the need of the rural sector in general and agricultural sector in particular. So main focus of cooperative banks is the rural sector, including the agricultural sector, and it provides short-term and medium-term credit to agriculture. Another important aspect of cooperative banks is it charges lower interest rates as compared to commercial banks. So cooperative banks have a developmental role, greater developmental role as compared to commercial banks. So it has three basic categories: state cooperative banks, central cooperative banks, as well as at the very local level, primary agricultural credit societies. Next category of banks within the country is that of development banks. Now these are banks which are not there for commercial purpose, or they are not in the market for earning a profit, but to develop certain specific sectors of the economy. So first broad category is industrial development banks. So as far as large scale industries is concerned, there are banks like IDBI and IFCI. For small scale industries, we have the SIDBI. So as far as development of export and import business is concerned in the country, we have the Export Import Bank or the Exim Bank. Further, moving on to agriculture development banks, we have at the all India level NABARD. At the state level, we have various state level development banks and local level and branches, etc. of PLDBs and SLDBs in the country. Now, as far as these banks are concerned, for the purpose of your paper, it is very important that you learn a few facts about these important banks. So, first you will learn the year of their establishment, their headquarters, and their main functions performed by banks like NABARD, SIDBI, etc. So during the course of this video presentation, firstly, we saw the major events of the evolution of banking sector in the country. Secondly, we saw the important laws or legislations related to or regulating the banking industry in India. And lastly, we saw the broad structure in which the banking industry in the country is divided, taking a look at the different types of banks in the country. Thank you very much.